Hey everyone, Brian Bogner and Greg Towner here with Parallel Portfolios, and it is January 2018, so we are here to tell you what we're looking at here in the markets for 2018. So let me go ahead and share my screen with you, and let's get started. Now, it's important that what we're going to be talking about here is what we are looking at for 2018. This is not a prediction. This is not a forecast. This is not something where we're going to tell you what exactly is going to happen. We do not have a crystal ball, okay? What we do is we have a rules-based investment management system that helps us navigate what the markets are doing. So just keep that in mind as we talk through these points today. So let's start, Greg, with what is happening right now in the markets, right? Stocks are doing what? They are making all-time highs here. They just seem to want to go up, 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 and up. So can you talk to us a little bit about that?
Yeah, absolutely. You're right. It seems like every day practically now we have a new high in the market. We always like to start with the actual trends of the market. We look at a lot of fundamentals. We look at quantitative analysis. At the end of the day, what is price actually doing tells us a lot. Nice sustained trend the last year, but now here in the last few weeks, really going almost straight up to a level that is just not going to be sustainable for long. We think that sentiment in the very short term has maybe gotten a little bit ahead of itself, but we also know that whenever there seems to be any kind of minor correction, that sentiment turns the other way really quickly, which means that people think there's going to be some crash or what have you. But we're not seeing that. A lot of the internals are really good. Trends are really good. Maybe we need to consolidate in the near term. But when we look at things, clearly we're overbought now in the short term, whether you look at moving averages or other metrics. But as we move forward, overbought isn't necessarily a bad thing. It scares a lot of people, thinks we've gone too far too fast. But this study really opened our eyes. It goes back all the way to the 1920s. The level that we recently reached as far as an overbought metric on the far right there in that green arrow, you can see other times going back over history where we've reached those same levels. And if you look at the market going forward at that point, good, healthy returns. In fact, if we were to dig into it and look at the 12-month forward returns when we reached those kind of overbought levels, they actually were better than normal market averages. So overbought at certain times can actually be a good thing. It's showing demand for equities, and we think there's a decent chance that that continues.
Excellent. So we've talked about stocks. Now let's talk about the bedrock cornerstone of our economy, interest rates.
Yeah, absolutely. We haven't talked a lot about interest rates on these calls. We know everybody likes to talk about stocks, but interest rates are something we look at a lot. And before we get to talking about the 10-year rate, which a lot of people look at, we think the 2-year rate is really a big key. Some important research we've looked at shows that the 2-year rate, particularly when it's increasing, is really indicative of a strong economy and strong stocks moving forward. So we're seeing that. We're seeing other positives throughout the credit markets that are very healthy, and we're not seeing any problems in yields right now. Now, getting to that 10-year rate, this is a long-term chart, 15 years. You could go back 25, 30 years. The story is going to be the same. Rates have been declining seemingly forever. But we think that's changed. At the very least, the downtrend has ended, and we're kind of moving in a sideways pattern now. We think there's a decent chance that we're breaking out of this basing pattern we've been in. We could see longer term rates move forward this year and really in the years ahead. So the key levels, everybody wants to know what level is this 10-year rate going to be a problem for equities? When is it going to be too high? And that's hard to answer. Some people think it's 3%. We think it's north of 3% where maybe it becomes an issue, whether it's 3.5%, 4%. That's hard to say. But we're going to be watching this year to see if it does get to those levels, how do stocks react to those new interest rates?
Excellent. So we've talked about stocks, we've talked about interest rates. Now I got to ask you about the US dollar. Your thoughts?
Yeah, that's right. There's a few things here. These next few charts are all going to kind of tie in a little bit. US dollar for really the last year has been declining pretty hard. And we think there's a decent chance that continues throughout 2018. Maybe we're a little oversold here in the short term and it could bounce. But the dollar is declining. There's a lot of ramifications for that, some positive, some negative. But the one we'll focus on today is actually it can be a positive for a lot of U.S. company earnings. If you think about some of these big multinational companies that have a lot of sales overseas, that really benefits their earnings. So that could be a positive to keep growing the earnings. Now the next chart is inflation. A lot of this ties in together. This is a long-term chart, but over the last just few years, inflation has stayed right around 2%. And the reason this is so important is because that fairly low level has allowed the Federal Reserve to be very slow in their raising of rates. And that's certainly helped stocks and helped the economy. If we start to see inflation tick up, 3% or more, the Fed might get a little uneasy and might start to raise rates a little quicker. So this is something we're watching very closely. There's some concern that inflation is picking up. The headline numbers aren't really there yet, but it's getting closer. So something we're watching closely. And something that ties in both with inflation and the declining dollar are commodities. We haven't talked about commodities a lot, but after a long-term downtrend, commodities based out for a couple of years, and we think that they're increasing. Commodities tend to do well when inflation is picking up, when the dollar is weak. We've actually, in a lot of our portfolios, been exposed to areas that benefit from rising commodities, materials and industrials, more recently energy. So if commodities really take off, it can be positive for some areas of the economy, but it also can be a drag on costs for firms and can hurt inflation. So something that we're watching closely there. Now this is our last chart here, Brian, and this is something we've talked about really probably more than anything except trend for the last year, the strength in earnings. I think investors still don't realize how strong earnings have been, and they've really been highly correlated with stocks. We think that the earnings will continue to increase throughout 2018. The economy here in the US is doing well. Perhaps more importantly, international economies are doing well. Of course, the tax cut to corporations is going to boost their earnings. And one area that we think is maybe not factored in yet is a potential for a fiscal spending plan around infrastructure. So earnings is very important for the economy, and we think that is looking good for the rest of 2018.
All right, Greg. So stock trends remain strong, right? And we're big trend followers here at Parallel. So, we say the trend is your friend, and if it's moving up, keep moving with it. Interest rates are healthy, but because long-term rates look like they're potentially bottoming, moving higher, we're going to keep a good watch there. Dollar, of course, dollar could potentially, it's breaking down here, which might bring in higher inflation, which could also be commodity prices moving higher. So really watching that relationship, we're going to be looking at that. And then positively, earnings in the economy here are still improving.
That's right. A lot of positives. We have a generally positive view on things, but of course, Brian, there's always risks and concerns out there that we're monitoring. But we also know that sometimes it's the risks that are hard to know are coming that can upset things a little bit. So we always have a risk management plan in place for all of our strategies. If you have any questions on what we talked about today or anything else, please, of course, call us, email us anytime. We'd be happy to answer for you. Thank you for joining us. We look forward to seeing you again next month.